Moving on to buying puts. Buying puts is kind of like insurance, or to play a bear market. We all, when we buy a house or somebody buys a house, they buy insurance on it, just in case it burns to the ground or, something catastrophic happens. That's kind of the way I think about buying puts. I don't necessarily think that the market's going to go down, but I do want a little bit of insurance, especially when the market's been at all-time highs or I've seen a huge gain in my stock. I'm up 1,000% in my stock, so to speak, or several 100%, and I want to protect some of those gains. I have a little bit of extra money that I can put out there just to make sure that if there was a bad news or if there was a major market correction, I will be protected. I'm not a huge fan of buying puts. I'm not a huge fan of actually paying to do anything in options, but I do know several people that have made millions buying puts, and those people took a lot of heat for a long time and laid out a lot of money to buy these puts throughout their trading careers, waiting for that one huge sell-off. And I know a guy that made several $1 million, double digits $1 million in one day, and that was in the stock market, .com bubble. So that was quite a while ago, and I think the guy basically retired right after that. He made so much money, it was just insane. So there is a lot of money to be made in puts, but there's also a lot of money to be lost in puts because you're constantly laying out the premiums. When buying puts, you will profit when the underlying drops in value. It's got to be more accelerated than the theta, and if there's high implied volatility, it's got to move quickly right away. Otherwise, that decay, you may be directionally right and it goes down, but you got to think that the theta could eat you up, especially if it goes sideways. If it goes down a lot, you put it to the seller, which means you sell your stock to that guy or gal. And because it offers you the right but not the obligation to sell the 100 shares at that strike price. The advantage is that it will limit your losses, for sure. The disadvantage is that it will increase your break-even price. So if I bought the stock, at $70 and I pay $3 for the option, then it increases my overall break-even on that stock. And you got to keep track of that because if you continually roll these puts forward in time, that's going to continually increase your break-even point on that stock. So ultimately, you might be selling that stock or putting it to the seller at a loss.